and welcome to this presentation on fixed income for the CFA Program Candidate for Level 1. This presentation has been brought for student candidates for 2021 and 2022, appearing wherever you are. And this is the first of the series of many such videos that I'll be uploading absolutely free of cost to help you out. I know that this has been a difficult time, but I think that in my limited ways, if I can ease up that situation in whatever way I could, and if it benefits even one candidate, I think my hard work will pay off. So without much ado, let's start off. A small disclaimer, basically all that it talks about is that this is my own work and CFA has really got nothing to do with it, and I really do not endorse, neither does CFA endorse each of this work, blah, blah, blah. You're advised, in fact, to pause the video and go through it minutely. Okay, so to begin with, this is the first chapter, and we're going to discuss about what is bonds and what is meant by the indenture or the trust deed, what are the various kinds of covenants, what are the different kind of issuers, what are the legal and the regulatory hurdles, how a cash flow is being managed, and what is meant by the contingency provision contained in the trust document. So what exactly is a bond? Well, not quite what is right now appearing on the screen, but I can assure you that sometimes, notably the investment bankers, they do behave like the 007. Okay, so let's not focus on that. Let's basically talk about what bond is. So it is, to begin with, a bilateral contract between two people, right? Which are those two people? So one is an issuer. Let's say he is an issuer. And then there is somebody who is called the bond holder. Okay. So essentially, as you may understand, that this person wants to raise money through something called as a debt fund, and this person wants to invest in this. So essentially, it's a bilateral contract with certain conditions being put in. So what is the first condition? The first condition is that this person, that is the investor, is going to purchase the bond. Of course, we are talking about the initial market, which is very, very akin to the IPO market of a stock equity. So as with a new issue, a bond investor is going to purchase the bond and whatever the price is, and the basic understanding is that against that purchased price, the issuer will periodically remit this investor something called as coupon. Okay, and then this coupon will continue for the tenure of the bond. So what is meant by tenure of the bond? The tenure is basically the day that the bond has been issued, that is t is equal to 0 to, let's say, t is equal to t, which t can actually range from as low as, let's say, 1 day to 30 odd years. So in between, there will be days on which this issuer will be making the payments to the holder or the investor, which are called as the coupons. And at the end of the tenure, the issuer will finally remit or redeem the principal. So it is as simple as understanding that if you put in, let's say, $10,000 in a bank's account, let's call it a fixed deposit, and against that the bank pays you, let's say, 6% per annum, so which means that you will entitled to receive $600 every year for the next 20 years. So the very minimal concept of bond is something similar to this. Okay, now some of the bonds also may be issued at a discount. What we meant by discount is that you will not be receiving any coupon whatsoever, or you may also receive a coupon, but you may have to pay, let's say, $800 today. Okay, and against that $800 of investment at t is equal to 0, for the next, let's say, 5 years, you will be receiving some coupon, let's say that is $40 at each period, and at the end of the tenure, you will receive the last coupon, which is, let's say, $40 plus this principal of 800 plus another part of the interest inbuilt in it, which will make it, let's say, $1,000. Okay, so this would mean that the bond was issued at discount. Similarly, bonds can be issued at premium as well, which would mean that you might have invested today, let's say $1,020, and at the end of the tenure, you're going to get only $1,000 a part of your principal. Okay, you might get the regular coupon as well. Now, this $1,000 which you're going to get at the end of the tenure is called the face value. Okay, so you have the face value, which is basically nothing but, this is nothing but the principal or the principal, including the final interest, and you're going to get this periodic coupons. Okay. Similarly, bond can also be issued at par, which would mean that you would invest $1,000 today, and you will get, $1,000 as part of your principal back, plus in between the interim interest periodically. Okay, so this is the overview of what a bilateral contract in the form of bond is. So bond, basically what it means is that it's an English term which is being derived. What it all conveys is that it's part of a promise. It's part of a promise. Who makes the promise? The issuer makes the promise that he is going to redeem your principal amount which you have lent him, and along with that you will get the periodic coupons or the periodic interest part, which is basically nothing but your cash flow. And at the end of the tenure, he makes the promise of returning the principal which he has lent you. Okay, now some of the bonds might be also like this, that they are issued at t is equal to 0. It does not pay any coupon whatsoever in the interim period, but at the end of the tenure, it gives you a lump sum amount. So say you have invested, let's say $1,000 today, and at the end of the tenure, you might get $10,000 you have invested today, and at the end of the tenure, let's say 5 years down the line, you will not receive any coupon whatsoever, but you might receive, let's say, $15,000. So all that it means is that the coupons of the interim interests are actually getting inbuilt here, and it is getting accrued out here. So bond of such natures are called zero coupon bond, because they do not pay any coupon in the intervening period whatsoever. Okay, so with this basic understanding of bond, let's move ahead. So bond, first and foremost, they belong to a family of asset class which is called as the fixed income. As you can see, the difference between these two people, this person is considerably fatter, not necessarily healthier, of course, than this person. So what this talks about is, what it conveys is that as an asset class, this happens to be the biggest asset class in the world which are traded. Okay, so as part of the tradable asset classes, it's not the equity, it's not even the commodity, but bond or the fixed income asset class is the one which is biggest. Okay, so along with that, we talked about the maturity scale. So as was mentioned, that the maturity can be as low as at 1 day, let's say overnight. Bills and notes, mostly the bills, and mostly issued by the government, or let's say by the commercial banks, and the maximum tenor could be that of 30 years, again issued by the government, let's say the treasury bonds. So the treasury bonds could be ranging from a minimum maturity of, let's say, 1 day, wherein we will not call them bond, but we will call them bills, or let's say notes, and any maturity of more than 1 year, we will call them the bond. So the maturity of the bond can range from 1 day till 30 odd years. Of course, you may understand that the corporate issuers are going to range somewhere in between. Okay. Now, how many types, how do we classify? Well, we are going to classify the issuer type in 7 ways. So how are the 7 ways? So first is the supranational. So who is the supranational? So let's say World Bank. So World Bank is a supranational issuer, or let's say European Commercial Bank. European Commercial Bank is a supranational issuer. So who is a supranational issuer, or what do we mean by that? So it's basically nothing but these are the institutions which are backed heavily by credible sovereigns, and they have their investment market across the world, wherein they can issue the bonds. They're allowed, they're highly credible, and they almost act as if they are issued by a solid backing of a credible source. They're called the supra issuers. Similarly, there could be bonds which are called the sovereign bonds. The sovereign bonds or the sovereign fixed income securities are the ones which are issued by the government. So the closest that you can think of are basically the treasury securities, right? Which are also called in other countries the G-SECs. Okay, so government securities, basically that's what it talks about. There could be local governments as well, which are basically nothing but, let's say, the municipality or the local taxing authority in a particular area or a particular governance. So those are called the non-sovereign government bonds. What is the difference between the sovereign bonds and a non-sovereign issuer? Well, for all practical purposes, both of them carry very high rating. Of course, this is the default free rating of any particular sovereign when they're issuing in their domestic currency. And this would mean they're almost similar to that of the national government, but for a couple of things. One is that they are not really 100% backed by the credit faith of the government. What is meant by the credit faith of the government? Well, the sovereign per se really cannot default on that domestic issue. Practically, it cannot, because worst comes to worst, what it can do is that it can always print money in order to pay off the debt, which is famously termed as quantitative easing. Okay, of course, it does raise the problem of inflation to a significant amount. At the same time, sovereign issuer is also governed by a lot of policies, mainly the banking policies and the financing policies, or the economic policies. So economic policies could be that of the monetary economic policy, or the expansionary economic, or the economic policy could be monetary or the fiscal policies. They are the cornerstone why and how a sovereign might issue a bond. And they're, as I said, that they are fully backed by the full credit faith of the government itself. But the non-sovereign, basically, since they are local bonds, local municipality has the authority to issue a bond. So they are backed by certain project, or they're backed by the localized collective power of the government. So the local taxes are the ones which can actually back up that. Nonetheless, they are also very highly rated. Next in line is, of course, the corporate. Of course, not every corporate will find the takers when they issue a bond. Of course, the credible power corporates are there who issue bonds in the market. So the $1 million question is that why would a corporate issue a bond instead of going to a bank? Well, it's like this. I'll just do the math in front of you. So let's say there is an investor out here, and let's say there is a bank out here, commercial bank, and then let's say there is a corporate issuer. Okay, so the corporate could go to a bank, but if it does go to a bank, the bank may stipulate a certain conditions which the corporate may not like, right? Secondly, the bank may also charge a rate of interest of which the corporate may find too steep, right? On the other hand, think about it from the depositor's perspective. If the depositor goes to the bank, he might really not get much. It's almost negligible or zilch. There could be investors having varied risk appetite who would be more than willing to lend this corporate directly bypassing this middleman called the bank, the commercial bank I'm talking about. Okay. So in this case, what happens is that, well, having a direct access would mean that they could actually, from this investor's perspective, his yield can jump. Yield means whatever he can actually get out of his investment. So from 2% merely what he would have gotten from depositing in the bank, local bank, he might get 6%. And on the other hand, the corporate may think that 14%, well, it is way above the market rate. For him, 8% would be somewhere a great deal. So it becomes a win-win kind of a situation. Of course, the actual bond market is not that simple as it sounds like, but it was just to drive home the point. All right. So amidst all of this, there is also something called as the trustee of an issue. Who is the trustee of an issue? Well, we need to understand that while a bond is being issued, there are still certain risks associated with the bond. Namely, first and foremost, is the default risk. So what is meant by the default risk? The default risk necessarily means, what if the issuer fails to pay the coupon on time? What if the issuer fails to redeem the principal when it is due? What if the issuer really does not have the best interests of the investor in his fold. So there needs to be some sort of guarantee per se. I would not say guarantee, but we'd see there needs to be certain officiating body in between who is going to look at the larger interest of the bond investor. And that is precisely where a trustee comes into a picture. So the trustee, for all practical purposes, is appointed by the issuer. More precisely, it is basically a commercial bank itself, which assumes the role of the trustee. And all that it does is that it acts on behalf of the bond investor, right? So appointed by the issuer, yet works for the bond holders. Okay. So what does the trustee does? So the first thing is that, as I said, that they're going to see overall whether the issuer is true to its word. So first and foremost, they are going to constantly have a vigil over the financial health of the issuer. So for instance, if the issuer is running into some sort of potential problem which might jeopardize the forthcoming interest payment, which we have termed as the coupon, or the financial position of the issuer be such that it can easily spiral down to delinquency or in the default category, or there be a rating downgrade. So all of these things are important, right? At the same time, the trustee also ensures the distribution of cash flow. So what is meant by the distribution of cash flow is basically nothing but it's bookkeeping job which is there. So it ensures that the cash flow gets distributed to the rightful owner of the bond. Okay, so because in the secondary market the bonds can be traded, so the bookkeeping activity is also being entrusted with the trustee. So second thing is, this is the second task. The third is to ensure that the collateral are basically nothing but the security that backs that particular issue. So as you may understand that if I have to borrow from you, I need to have some sort of guarantee that you are not going to default. And should you default, then there has to be some sort of recourse. So the collateral actually acts as a recourse. So more often than not, these collaterals are basically the assets that sit on the balance sheet of the issuer and some traded or non-tradable securities. So the health of the collateral is also important, and the trustee keeps a close eye on that as well. So basically, in nutshell, the trustee is appointed by the issuer, but it acts for the bondholders, and it periodically checks on the financial health of the issuer. It ensures the cash flow distribution in the timely and the effective manner. It also oversees the health of the collateral or the assets that are backing the particular issue. So that's the job of a trustee. We will come to that when we study the subsequent chapter. So one trivia question to all of you: why a fixed income is called a fixed income? So is it because that it pays a fixed coupon? That is why. Or is it something else? Why it is not known by something else? Why is it called a fixed? Why a fixed income is called a fixed income? Think about it and let me know as we finish the chapter. All right. So who are the parties to the bond issuer? So of course that has to be first and foremost, as we said, that there is a trustee, and these are the job of the trustee, represents the holder, the administrative function, and having also the discretionary power, because in case the issuer goes bust or the issuer has certain credit issue, the trustee can actually assume the role of the issuer itself, but will act in favor of the bondholder. But is that all to it? No, definitely not to it. Nobody is going to purchase my bond in the market just because I intend to raise some debt, raise some capital. I need to have those kind of credibility, and I need somebody, again, more credible to attest my credibility. So that is where a few more parties come into picture. Plus, of course, I need certain insurance. So as I said, that what is the risk to investment as we can talk about? So the first risk that we can think of is that of default. So default of coupon or the principal. And the second is basically what we call as the delinquency. Mind you, the word may differ because it's not explicitly mentioned in your text of CFA, but as a practitioner, I can tell you that this is also one of the risks. So what does delinquency mean? Delinquency means basically, in the shortest form, it means that delay in the scheduled payment. So the issuer may actually pay, of course, but instead of it was supposed to pay on the 15th of June, let's say the semi-annual coupon, instead of 15th of June, it has some cash flow problem and it ends up paying on 12th of July. So there is almost a delay of a month, and there is an imputed interest in it, which the investor has actually foregone. But more often than not, a continuous delinquent issuer will eventually fall into the default category. Okay, so these are the primary two risks against which the issuer is against which the investor needs a protection or some sort of guarantee. And then there are some elements to ensure that. So first is, obviously, we need an officiating body to monitor the day-to-day operation that is being executed by the trust and the trustee, right? Second is, we would also require, as we say, that some sort of protection. So that protection is being provided by some monoline insurers. We will come to know that what is meant by these monoline insurers who actually provide those kind of guarantee. CLN, CDS, these are the terminologies we will learn in greater details as we move ahead, and I assure you that you're going to enjoy it. But just know this, that there are insurers who actually provide guarantee against the default of the issuer. And secondly, the assets backing that particular issue, which we talked about, the collateral. Of course, amidst all this, the legality part of this is also equally important. So there are lawyers, attorneys who actually vet the entire issue to ensure that in case the issuer defaults, the bond holders have some sort of recourse, which is as much hassle-free as possible and bereft of any sort of legal hurdles. Now, coming to the rating agency. So you might have heard of rating agencies like Standard & Poor or Moody's, okay, Fitch. So these are some international, world-renowned global agencies who regularly vet and regularly issue their rating against a particular issue. So as we would know why a rating agency comes into picture, again, we will discuss that greater detail when the subsequent chapter comes in. Know this, suffice this, that the rating agencies issue rating from the category of AAA, which is called the highest form of rating, a default-free rating, as we call it, to something called as the D category, which is the default category. And just above that is the C category, which is called the junk category. Okay, so these are different kind of ratings. The ratings are basically, there are one alphabet or two alphabet representation of the quality of the issue itself. Now, there has to be now some vehicle to undertake this issue, market it to the prospective investor, and ensure that the issue is fully subscribed. And that is the job of the underwriter. More often than not, these underwriters are the investment banks itself, and they work on some commission basis, of course, on either a best effort or they purchase the bond by themselves, full guarantee, or a best effort basis, as we will come to know about them as well. So this is the overall structure of this, and all of this, the legality part of it, the trust, the deed, the role of the trustee, what are the credit enhancements that have been provided, what are the collaterals backing the issue, everything is going to be mentioned in the bond prospectus. And potential investors are always advised to go through the minutest details of the bond prospectus before taking a decision. Okay, so how may we categorize the bond? So first of all, we may categorize by the coupon pay. So there are zero coupon versus coupon paying bond. We already talked about what is a zero coupon bond. Just know this, that from the tenor, from the day the issue is, let's say, first floated in the market, if the issue does not pay any interim coupon itself, that's called a zero coupon bond. All that it is talking about is that at maturity, I'm going to get something as a lump sum, which will obviously have the inbuilt coupon itself. Just that the cash flow does not have an interim. Second is the fixed pay versus the floating rate note. What it means by that is that, let's say there is an issue in the market paying 8%. So what it means is that from the day the issue has been floated in the market till its redemption, let's say it's a yearly pay bond. So first year, second year, third year, like this is the 10th year. So every year this issue is going to pay 8% of the face value. Okay, so let's say the face value is always denoted as either 100 or more noticeably 1000. The general convention is that the face values are mentioned as percentage of 100, but every instrument in the bond market carries the denomination of either of these two. Okay, so how much, let's say if I'm investing, let's say 6 million in this particular issue, so how many instruments I will get? It is a simple division of 6 million divided by 1000. Okay, assuming that the issue is issued at par. Okay, what is meant by issued at par? Which means that you are going to pay $1,000 today to receive $1,000 back at the end of the tenure. That's issued at par. We discussed this in the first slide itself. Okay, so how many types of coupons are there? So one is a zero coupon bonds, in the fixed coupon paying bond, wherein you're paying 8%, and then third category, which is also called as the floating rate bond. What is meant by floating rate bond? So floating rate bond means that the bond coupon, well, more often than not, its coupon, they are going to adjust themselves along the market interest rate. Now, why this market interest rate is so much of an importance? Because of nothing but the opportunity cost. Say, for instance, if you have, let's say, $1 million, or let's say $100,000 at $100,000 at your disposable to be invested, where are you going to invest? What is the safest interest? What is the safest investment vehicle? So you might say that the safest investment vehicle is that of the treasury, wherein I'm only going to get 2%, but that's completely guaranteed. That's right. So against that, you're only going to invest into a bond which pays more than 2%. Of course, it will be not as safe as that of the treasury security, but pretty much safe, right? So let's say that's 4%, right? So you're happy collecting 4% instead of 2% of treasury. But let's say 10 years is a long period. So within this 10-year, let's assume that when you had actually purchased this bond, invested $100,000, you saw that the market interest rate was static, flat at 2%. And against that, there was a very credible corporate in the market as an issuer, which was paying 4%. So obviously, against this 2%, 4% sounds good, sounds better. But what if 5 years down the line, let's say the market interest rate itself gets revised to, let's say, 4%. Now, is this 4% corporate issue is still as valuable as it was? I guess not. Why? Because now not only your additional yield has completely vanished, completely eliminated, but you're actually earning same as that you would have earned by investing in government securities, yet you're carrying a little bit more risk, right? So to beat that, there are issuers in the market, again, depending upon the appetite of each and every investor, who are ready to adjust their coupon based on the default interest rate in the market. So instead, let's say 2% is there. When it was 2%, the issuer was giving you 4%. So 2% additional yield or 200 basis additional yield you were enjoying. But when it becomes 4%, let's say the issuer is now ready to give you 6%. All that it means is that it is ready to adjust its spread over this benchmark default free rate in order to keep the issue as enticable, as appealing, as attractive as it was before. So this means that the coupon rates are adjusting to the market interest rate. Okay, so these are called the floating rate notes. So you have a fixed rate issuer, you have a floating rate issuer, annual payment versus semi-annual versus a quarterly payment. All that it means is that there are issuers who pay once in a year coupon, there are issuers who pay twice in a year, and then there are issuers who pay quarterly basis as well. This is also called as a straight pay versus the deferred coupon, and also says something called as a step-up coupon. So let's also touch base this one. What is meant by straight pay? Straight pay is just nothing but the example that I quoted here, that you're getting a default free, you're getting a 4% coupon every year. So that's basically straight. You're going to get 4% every year. That's it, right? But there could be, let's say, we are talking about a project which an issuer has embarked upon recently, for which it requires to raise let's say $20 million. Now, you know that the issuer is a good issuer, and against that, it is ready to offer you 10% yield. But there is a condition, there's a caveat to this. And this caveat is that because this project that the issuer is embarking upon is highly cash intensive, hence for the first 4 years, the issuer will not be able to pay you any coupon at all. So let's say if the investment tenor is that of 10 years, so for the first 4 years, you're not going to get anything. Okay, you're going to get zilch as part of coupon. But from the fourth, after the end of 4th year, 5th year onwards, you're going to get an elevated interest rate at the rate of 10%, or let's say 10% plus 2%, 12% is what you're going to get at the end of the 4th year, 5th year onwards for the next 6 years. Okay, so these are called the deferred coupon. Mind you, in this deferred coupon, what is happening is that you're actually foregoing the cash flow for the first 4 years only to collect them in an imputed manner, in a built-in manner for the subsequent coupon in the cash flow period. Similarly, there's something called a step-up coupon. The step-up coupons could be the ones wherein, let's take the same example that it's a cash-intensive, capital-intensive project that the issuer has embarked upon. And initially, it cannot pay you that much, but it still does not tell you that, I'm not going to pay you anything for the first 4 years, unlike the previous example I get. But instead, what I'm going to pay you for the first year, I'm going to pay 2%. The year after that, I'm going to pay 4%. The year after that, I'm going to pay 5%. The year after that, I'm going to pay 6%. So this is nothing but the step-up coupon. Of course, you may understand that why these kind of arrangements are being made is because, project varies, risk varies, cash flow varies, and the investments need to be matched with the project itself. So that's how the coupons are being adjusted. Okay, now coming to this amortization schedule. What is meant by amortization schedule? Let me just give you a little bit. Right. So primarily, amortization would be, retiring a portion of the principal periodically. Why that would be essential? Well, let's understand. If I am an issuer and I've issued a bond for 10 years, okay, and I promise to pay you coupon every year for 10 years, whatever be the, let's say it is X% coupon I pay every year. Okay, so at the end of the 10 years, I'm going to pay the last coupon of X% plus the principal, right? Two things would happen. One is that understand that I'm still paying X% on the principal every year. Okay, and second is that at the end of the tenure, I'm going to pay the principal at lump sum. Okay, so I could have a liquidity issue because nobody knows. Today my health is very good. 10 years down the line, nobody knows how I will be. Maybe my project will not be that much successful as I have initially envisaged. So I could have a liquidity issue. I could even have a credit issue. Okay, and both these cases will render the bondholder at a risk, right? Instead, think of a situation wherein the issuer, redeems a portion of the principal every year, or let's say from the end of the second year, every year till the remaining portion of the tenure. So what happens? If let's say I have invested $10,000 to begin with, so instead of collecting 10,000 at the end of the tenure, at the end of first year, my principal outstanding, let's say, becomes $9,500. Principal outstanding at the end of the second year becomes $9,000. So all that it talks about is that every year the issuer remits me $500. Okay, so how does it help? Well, it does a couple of things. One is, of course, it removes the additional burden of the issuer from the issuer's head, because at the end of the tenure, he need not have the same kind of liquidity pressure or the credit issue may arise because he's retiring the principal every year, piece by piece, right? And secondly, because at the end of the first year, the outstanding principal is no longer 10,000 but 9,500. If the issuer was paying, let's say, 6% coupon, so he will now not have to pay 6% on the outstanding $10,000 which was there to begin with. He will be paying 6% on this outstanding $9,500. And in the end of the second year, third year onwards, he will be paying 6% on $9,000. So like this, what would happen is that interest burden will also come down. So is it good? Well, again, as I said, that it all depends upon the risk appetite. There is a mix and match of various kind of investors in the market, various kind of issuers in the market. Who finds who for what purpose is really a choice at the end of the day. Now, let's understand from the investor's perspective what is happening. Well, to begin with, he is having some sort of guarantee. What is the guarantee? Is that his principal is is not that much in is not that much in the risk as it would have been had he only gotten the coupon now, and at the end of the tenure he would have collected his entire principal in a balloon fashion. Okay, he instead now is collecting $500 every year for the next, let's say, 10 or 20 odd years till he recoups his investment. So one thing is that, of course, his risk comes down considerably, right? But the trade-off to that is that he would also effectively will now be collecting lesser interest in an absolute value, right? So again, this is a trade-off. Nobody can say that whether it's right or wrong. It all depends upon how much risk you're ready to take. If you believe that you can absorb more risk with the $10,000 investment that you want to take, you may not like this. But if you believe that well, $10,000 is a big amount for me, and I still like this issue, but I'm not fully confident on this particular issuer or in this particular issue or the market condition itself. So it would be a great idea if I can have some portion of my principal back. Okay. In addition to this, please understand that once he receives this $500, he would still have to reinvest this $500 somewhere, unless, of course, he has some other purpose with this, right? So that raises something called as the reinvestment risk, which otherwise would not have been the case if he would have gotten the principal at the end of the tenure. Okay, so that's the amortization part. So amortization is nothing but basically retiring of principal on a periodic basis, and yeah, that's about it. Now, what is meant by balloon pay? Balloon pay is basically all that I talked about. A zero coupon bond is the perfect example of balloon pay. Regularly amortized combined with balloon pay, well, it's as the name suggests that some portion of the principal would be retired every year, and at the end of the tenure, let's say in our example, $500 would be redeemed every year after the first year. So by the end of the ninth year, $4,500 from the $10,000 principal would have already been redeemed, and now at the end of the 10th year, that is at the end of the tenure, the issuer will only have to remit the balanced $5,500. Okay, so that's the regular amortized combined with the balloon pay. And bullet pay, of course, we talked about. Types of bond issue, there are domestic issuer, foreign issuer, international bonds, global bonds. So let me just touch base upon this. Let's first talk about the global bonds. What we mean, let's talk first about the domestic bonds. So domestic bonds, as the name suggests, that the issuer is issuing the security within the geographical bounds of the sovereign. So that's the domestic issuer. A foreign bonds would be a US company, let's say we are talking about, let's say, Ford. So Ford Motors, let's say, issues a bond in India, where it also has its operation. Okay, so essentially it will be issuing the bond in Indian rupee. Okay, it may also issue the bond in USD, but that's a different story. For brevity's sake, let's just understand that Ford Motors, which is incorporated in the US, has an India operation and issues a bond in the Indian market. So from the Ford Motors perspective, this becomes a foreign bond. Okay, so global bond. So the global bond is that the same Ford Motors issues a bond in India, issues simultaneously a bond in its home country, US, and also issues in Europe. Okay, so at least one of the issue has to be in his domestic currency, domestic market, the market where it was incorporated. So that's called the global bond, so which presents with one market. And the international bond, it's basically the bonds wherein you issue it internationally without the recourse whatsoever. So, for example, a Japanese bond, yeah. So let's say a Japanese company issues a bond denominated in yen in the European market altogether. That becomes category of the regular issue of currency. Of course, what it means is that how are you actually redeeming the how are you actually paying the coupon, and how are you actually paying the principal amount at the end of the tenor or in an amortized fashion, whatever the case be. So if there could be a case an issuer issues coupon in dollar, principal also in dollar, perfect, all right. There could also be a case wherein the issuer uh, you know remits the coupon in dollar and principal in euro. Okay, there could also be a case wherein the issuer gives the option to choose either to have the coupon in dollar or euro, or the principal in dollar or euro, but he could pick only one. Okay, so this kind of option being also there. Okay, so this is the thing which we talked about, currency of issue, depending upon what kind of options are being presented. Number three, index bonds, international versus global bonds. So let's talk about what is meant by link. So with the understanding that we remember we talked about the floating rate note. The floating rate note is the primary and the perfect example of a indexed bond. What is meant by indexed bond here is that as per the market interest rate, okay, as per the market interest rate, the coupons adjust, right? Coupons adjust. So as I had quoted in the early example, the market interest rate was 4%. Market interest rate was 2%, and the issuer had floated an issue in the market at 4%. If the market interest rate becomes 4%, the issuer adjusts the issue and makes it 6%. So all it does is that the additional 2% spread which it was maintaining, it has maintained here as well. So this is the perfect example of the floating rate note. Now, is this the only one? No. Though there could be a couple of more variations to this. Most importantly, the floating rate is being benchmarked against a particular yardstick. I mean, for example, in this case, this happens to be the market interest. It could also be benched, or it could also be indexed, as I say, against a risk factor called inflation. So in case the inflation has now, which was the whole WPI inflation was, let's say when the issue was floated first time in the market was, let's say 2%, and 5 years down the line this becomes 2.5%. So this extra 50 basis point elevation in the inflation is being absorbed by the issuer itself. Now where the adjustment can happen? The adjustment can happen in the coupon, or the adjustment may happen in the principal, keeping the coupon in that, or it may be a combination of the coupon plus principal. All this flexibility exists. Okay, but the moot point out here is that where the adjustments are being made. So A, we talked about the market interest rate. B, we talked about the inflation. There could be other benchmarks as well. For example, certain bond index could be, bond index could be one. Credit worthiness is another thing. Okay, so as the credit worthiness goes up, the required spread is basically the additional margin that we talked about. So if the credit worthiness goes up, but obvious the additional required spread is going to come down. So accordingly also the floating rate note just its coupon payment. Similarly, it can be pitted against the bond index. So these are basically called the linkers, okay, where they're linked. Now there is one more thing which is important, and that is called something called as the inverse floater. So what is meant by inverse floater? So the inverse floaters is nothing but, mathematically speaking, it is given by X percent minus a certain float. Okay, what it means? So all that it means is that there is going to be a cap to this, and the cap is, let's say, 10%. Okay, and your coupon is going to adjust, and the prevailing market rate interest rate is, let's say, around 6%, and you're getting a coupon on this prevailing market interest rates another couple of 100 points, so basis points, so that becomes, your coupon becomes 8%. Okay, so in case this market interest rate comes down from 6% to, let's say, 5%, so the inverse floater is going to pay you the additional yield according to this formula. Okay, so now you would have been getting the additional yield that you would have been getting is here 6% plus 2%, 8% according to this formula, 2% according to this formula. This is the extra yield which you have got. But in case the market interest rate comes down by, let's say, 1%, so this now becomes 10% minus 5% plus the 2% spread which it was mentioning. So you're going to get this additional. Okay, now it may sound a little counterproductive, but please understand that all of these things are targeted towards making the issue as much attractive as much possible. Okay, so this is called as the inverse floaters. Bonds with contingency provision. All right, so this is the next important thing for us to understand, that what is meant by contingency provision, what are meant by callable bonds, convertible bonds, etc. All right, so we will touch base upon this in this chapter, while the subsequent chapters are going to cover them in details. So far we have discussed whatever bonds we have discussed, they fall in the category of something called as the straight bond. Okay, and as we know that more often than not, in fact, as always, the credibility of a bond, or the benchmark of a bond, or the interest rates or the coupons that one actually earns out of a bond is fully indexed to some sort of benchmark, and more often than not that benchmark happens to be the market interest rate, right? Market interest rate. Now let's take an example that where the market interest rate was 4%, the issuer in question was paying you 6%, which means that additional spread was 2% or 200 basis points. Now let's say there comes a situation wherein the market interest rate falls to, let's say, 3%, right? If it is a straight bond, then the issuer would still be paying a fixed rate bond. The issuer would still be paying 6%, which means that now he's paying an additional spread of 100 basis point. Okay, as compared to what the issue was when the market interest rate is 4%. So this makes this issue immediately more valuable, because it is paying a little bit more, in fact substantially more than what it was paying in the market. So such a scenario would render this bond a bit more valuable, right? Which means everybody would like to have a piece of this kind of bond which is paying extra yield in the market, had this been a fixed rate bond, right? So to protect the issuer against such kind of market movements, issuer sometimes also issues a bond with certain contingent provisions, and one of the contingent provisions is basically to embed something called as a call option. What is meant by call option is that if the market interest rate dips substantially low, which makes the bond extremely valuable, that is actually a detractor as far as the issuer is concerned, because the issuer technically could have issued in the market at the prevailing circumstances a bond at a lower interest rate, right? So his bond becomes immediately much more valuable than what it should be, right? Now to protect himself against such an opportunity loss, the issuer may reserve the right that if the bond price rises beyond a certain percentage at the fall of a market interest rate, then he would call back the bond, which means that the bond holder at that particular point in time will be compelled to immediately submit the bond and sell back the bond to the issuer. Okay, so those kind of bonds are called callable bonds. Similarly, imagine a situation if the market interest rate that we were talking about, instead of 4%, let's say it becomes 5%. So if it becomes 5% and the issuer still pays a 6%, that would mean that the issuer actually is now paying only 100 basis point more than the prevailing market interest rate. So from the holder's perspective, exactly the opposite situation would have happened now, because in such a situation, the holder is just earning 100 basis point more as compared to when they were earning 200 basis point. Now imagine a situation that this 5% interest rate actually now becomes 6% interest. So essentially, in such a situation, the holders are taking additional risk for their investment for earning the risk-free rate, which is really not the case. So in such a situation, in both the situation, the value of the bond in the market obviously will fall, right? To protect the bondholder against such a steep decline in their value, the indenture or the trust deed of the bond also embeds a certain option called as the put option. Now remember, the call option accrues to the issuer. That means that it works in favor of the issuer, while the put option actually works in favor of the bond holder. Okay, so these are the different kinds of bonds which are there. Now we shift our focus to a very, very important thing, and that is called as the convertible bond. So what is meant by convertible bonds? Well, convertible bonds would mean that essentially it has the feature of both the fixed income as well as the equity. Now, as we know that in a columnar structure, the debt sits above the equity portion, right? This debt sits above the equity portion, which means that the debt will have to be serviced first, and then whatever be the cash flow remaining can then go to the equity shareholder. Now imagine a situation that there is an instrument in the market which combines the goodies of both the world, which means that you can enjoy a coupon, and if there be an opportunity, you could immediately convert your bond instrument into common equity and enjoy whatever the upside the equity may offer. Wouldn't that be great? So such kind of bonds, such kind of instruments also exist in the market, known as the convertible bonds. So all that it talks about is that three things that we need to understand is that it has an additional advantage, which is in the hand of the bondholder, which they can exercise at their discretion to convert their debt instrument immediately into equity stock. Now, why would they do so? Well, just imagine a situation wherein the company's prospects or the issuer's prospects have suddenly increased manifold. It has advanced, it has improved, and it has elevated manifold. Wouldn't you like to participate in that upside potential? You would certainly want to, given a choice, right? With fixed income, remember I asked the trivia question, why fixed income is called a fixed income? It is not because of the fixed coupon, even if you're getting so. No. A fixed income is called a fixed income because at the end of the tenor, unless it's a perpetual bond, you're going to get back your principal, which is already known beforehand. That means it is capped. Okay. Whereas, unlike an equity, sky is potentially the limit, right? An equity share which you might have invested today, let's say only $100, may have a prospect to go up to $500 in 5 years' time. Who knows, right? Not so in case of a fixed income instrument. All right, let's coming back to our example. So if suppose there is an issuer in the market who tells you that I have an issue which you can purchase from me, and additionally, to sweeten the deal for you, to entice you, I give you a convertibility option. So the convertibility option works this way, that let's say against each of this bond instrument, I'm going to give you n number of shares. Okay, so the ratio becomes 1 upon n, right? For each bond instrument, you're going to get n number of equity shares. Okay, this is something called as the conversion ratio. Well, some decide the conversion ratio other way around as well, like per bond value, face value of the bond divided by the pre-decided equity price should the conversion be exercised, which is nothing but very similar to what a warrant would be, right? So, or what a stock option would be. So let's say, just for brevity's sake, just let's just say that, thus this kind of the pre-decided amount, the pre-decided price of that equity share be, let's say, $40, no, $40. So all that it means is that for every bond instrument, you're going to get 25 equity shares, right? So this is called also the conversion ratio. For every bond instrument, how many shares you're going to get. So this is the face value, and this is the pre-decided warrant price, which will be included in written in your bond indenture. Okay. So additionally, of course, the value of such a bond cannot fall below the value of an otherwise floor bond, because as you know that this bond anyway is valuable because it is giving you the option of converting into equity. So obviously this bond otherwise with an identical bond will be much more valuable to you. So which means an otherwise identical bond, the value of this bond cannot fall beneath that. So that is called the floor value of the bond. So the convertibles bonds value cannot fall than the value of a straight bond of similar nature. Number one. Number two, if such is the case, who stands to benefit? Of course, the holder stands to benefit. So should he pay a premium for this? Of course, he should pay a premium for this. So how should he pay the premium? By sacrificing some of the coupons which he would have gotten in the straight bond, right? So suppose the similar bond would have yielded him 8%, but because of this additional convertibility option, he's happy to take only, let's say, 6.75%. So he's ready to forego this 1.25% with the hope that in the near future, the company's prospect, let's say it's an EV company, or let's say it's a company into renewable energy or alternate energy. Okay, it's an upcoming company, or it's a company into artificial intelligence, Internet of Things. So the prospects right now may not be that visible, but let's say 5 years down the line, it might hold a huge potential. In such a case, the holder is ready to sacrifice this extra 1.25% yield with the hope that if 5 years down the line, the prospect, if it does improve, then I will immediately convert my instrument into equity, right? So he's ready to take this beating as far as the lesser yield as he's ready to convert it, as he may convert it. Okay. But also, if I were an investor, if I'm so sure about the company, why would I invest? Why would I not invest into the equity right away? Why would I invest into the bond right now? Well, as may be the case, today the company may be very risky. Secondly, such a company may not give me the kind of dividend that I would like to have. I like this interim cash flow. I enjoy this interim cash flow that comes to my bank account in the form of coupon. So I would be foregoing that, which I don't want to as of now. But 3 years down the line, 5 years down the line, situation might change, and then I would like to have this conversion in my bank account. I would like to do that if the opportunity does present itself. Okay. So given these conditions, company's prospect right now, company's prospect right now may not be that promising, but few years down the line, it does look good. So I'm ready to take a lower yield now with the hope that I may convert my instrument. Secondly, the company's current dividend ratio is really not attractive as compared to the coupon that is being. And number three, the value of such a bond is at least as much as that of the otherwise straight bond issued by the same issuer. When all of these conditions are being met, I don't mind owning a convertible bond in my kitty. Now, let's understand some of the mathematics here. So we decided already what is a conversion ratio. We're going to talk about the conversion value, conversion premium, conversion price. So the conversion value is nothing, but once you have exercised, your option. So let's say when you exercise this option at $40 was the pre-decided price, but if you exercise and you see right now the value of that the common share in the market is upward of, let's say, $125. Okay, So immediately, if your conversion value becomes 125 into 25, so the math comes out to be so $125 per share. It comes out to be $3,125. Okay, so this is my conversion value the day I convert share. Okay, what is the conversion premium? So the conversion premium would be nothing but if this bond is trading in the market anywhere less than this value of 3,125, which it should, because otherwise you would not have converted. So let's say it's trading in the market at that particular point in time. Because it's convertible bond, so the value obviously would be higher than a straight bond. But let's say it's trading in the market at $2,500. So you make a clean spread of $625 on this conversion. So this $625 is your conversion premium. Okay. All right. Now, a few more things that we need to understand. Just like a warrant, a convertible bond at conversion may dilute the equity value. Okay. Now, there is one more thing that we need to understand, that some of the convertible bonds may also be callable in nature. Okay. Why it would be callable in nature? The logic remains same, that if the prospect improves so much that the bond value appreciates much beyond the face value, the issuer actually now stands to lose. So in order to prevent that, huge upside potential in the value of the bond itself, so the issuer may believe that he needs to call back the issue itself before the price becomes too high, right? So in such a case, he may actually also embed a call option into the bond. So a bond can be simultaneously a callable bond, more precisely known as callable convertible. Now, here is the thing: if it's a straight bond, you are enjoying a coupon of 8%. If it's a convertible bond, you're ready to sacrifice that 1.25% yield, extra yield, and you're happy collecting 6.75%. But if it's a convertible, if it's a callable convertible, then what happens? Who does the call option benefit? The call option benefits the issuer. So, but obvious, the issuer now must pay the premium. So in this case, a callable convertible may be giving you a 7.25. So the extra 50 basis point, the extra 50 basis point is basically the price of the call option or the call premium that the issuer actually gives you. Okay. So that's the case with the convertible. Now there are some few more things. There is convertible, there are puttable bonds also in nature, as we have discussed earlier, that a puttable bond are the one which actually protects the bondholder, as the callable bond protects the the issuer itself. So similarly, there are contingent convertible also, which are called as the COCOs, the contingent convertibles. These are essentially the convertible bonds having the put option. Again, the same logic, applies here, but just in the reverse case. So in this case, the company's prospects have deteriorated. In earlier cases, what we talked about, the company's prospects have improved, but in this case, the company has fallen into bad times. So protect the bondholder from such an issue. So what happens is that the issuer may force this put option, or at least provide this put option, so that the holder may convert immediately their bond into common equity. How does that help? Well, how it helps is that immediately, from the issuer's perspective, what happens is that he would have avoided an imminent default. Okay, so that is going to give him a breathing space, as we talked about, that the company has fallen into bad times. It's just exactly opposite to that of a callable convertible. So he may have just avoided an imminent default. Secondly, the burden of meeting the interest cash outflow, interest expenses, is now dispensed with, and you make your bondholder party to your company's prospects. So it might also so happen that right now the prospects are bleak. However, in a couple of years down the line, the issuers may actually put in the requisite effort and the prospects may improve further. So in this case, the potential upside may still be enjoyed by the holder, albeit with some patience. So these are called the contingent convertibles or the COCO bonds. All right. So far we discussed about the yield of a bond. Exactly, we without knowing what a yield is. So let's just understand. We talked about the some benchmarking of the coupon. That benchmarking of the coupon happens in some market interest. So technically, for all practical purposes, this market interest rate can be termed as the yield of the bond. Okay. Now, when we talk about the yield of the bond, there are a couple of things which culminate into the total return. So first is the regular income, happens with the coupon payment that you get, and second is the capital return. As we talked about, that if the market to interest rate, which is basically more often than not the treasury interest rate or the GSEC interest rate of similar maturity, if the market interest rate comes down, okay, so the value of the bond goes up. Why it goes up? Because we know that if the safest security, which was giving 4%, now gives only 3%, and while you are giving, the issuer was providing you 6%, 6%. So now there is the extra spread of 2% has now increased to 3%. So obviously your bond becomes more valuable. It's no rocket science, right? So reverse is the case. So all that it means is that if market interest rate comes down, value of a bond goes up. Market interest rate goes up, value of a bond comes down. Every other thing remaining constant. Okay, so this inverse relationship should always be embedded in the mind, right? So accordingly, the market gives you the capital return in terms of the value of a bond. So the carrying value of a bond could be, let's say you have purchased an issue at $800 a piece, right? With the promise that you're going to get $1,000 at the end of the tenor, right? Or you're going to get, let's say, 800 back, so issued at par. Now, because of the market interest rates fluctuation, this value keeps on fluctuating as well, right? It keeps on adjusting itself because that's how market is going to value. So that forms part of your capital return. So your coupon income plus your capital income, both of them put together, makes your total return. Now let's just focus our attention to this particular graph. So this is a small graph wherein the price of a bond and the yield of a bond is being plotted. So if you plot any of the bond, more often than not, they're not going to look this perfect nonetheless. But this is how this curve is going to look like. So this is a very famous PY curve, or this is actually the inverse price yield relationship depicting curve. And so it talks about the convexity of the price yield curve. And this is something which you're going to live for the rest of your professional life if you're going to work in the fixed income department of the fixed income industry. All right. Now, yield to maturity, current yield, these are the couple of things. And then we're going to talk about the cash flow management with backing. Let's just pause to this video and we'll come back later to complete this chapter. All right, so we are back again. So to understand the yield definition a little bit, start and work out an example. What is the meaning of yield to maturity? And then what is the meaning? So let's say we have an issuer has issued a bond and it's priced at, let's say, $800 per instrument, and it gives let's say 7% coupon paying annually, and the tenor for this is, let's say, 10 years. Okay, as usual, the base value obviously is going to be 1,000, and So we are asked to find out the yield to maturity of this bond. Okay. So we can do it in two ways. Let's understand the basic principle first. So all that it's talk about, let's graphically plot first the uh, problem. So we have t is equal to 0 here and t to 10 here. So in between there are 9 intervening periods: 2, 4, 5, 6, 7, 8, 9. Okay. So t is equal to 1 here, is equal to 2 here, 3, 4, 5. That's how it is 10. So what it talks about is that the issue today is priced at 800 and it's paying 7% coupon. So that means 7% is paying here. 7% of face value, 1,000, would turn out to be 70. So 70 is being paid here, 70 is paid here, 70 is paid here, all the way to here, 70. And at the end of the tenor, you're going to get back the principal. So all put together is 1,070 is what you're going to get. Okay. All right. So with this, we are asked to find that what is the YTM. So we can do one thing. One is that the present value, the theoretical price. So the present value is 800. Say that 800 equals, because you will be investing 800 bucks. So 800 equals 70 by 1 plus R, assuming R is the discount factor. 70 divided by 1 plus R square, and 70 divided by 1 plus R whole cube, to all the way to 70 plus 1000 divided by 110, right? This must be the case, right? This must be the case. That is how it is issued. Now what is this R? This R is the discount factor or the market interest rate, or what is also known to be the yield to maturity. Now why it is called yield to maturity, we'll come to later on. So we can do in a couple of ways. One is that we do the hard way, wherein we manually calculate, we do a trial and error and put a certain value. Or what we can do here is put our calculator to work. So in calculator, all that you have to do is to open your calculator and input the value. So we write minus 800 because this is cash outflow in the, is equal to PV. 10 is equal to N. Okay. 1000 plus, this is what you're going to receive at the end of the tenor, is your face value. PMT, that is payment at each period, is also your coupon. We write as 70, and we have to find what is the I by Y, which is the yield to maturity. Okay, so your calculator does the work for you. If you input these details, this 1, 2, 3, 4, these 4 details, if you give, the Calc C is going to give you the 5th detail. So let's just do the math, and before that, set your Calc C, clear all your work. Okay, with this now, I'm working the math for you here. It comes out to be 10.29. And that, ladies and gentlemen, is your yield to maturity. Now, the more important thing is not this 10.29. More important thing is what exactly has been meant by yield to maturity. So you need to understand 3 things. This yield to maturity, of course, as it has been presented through this calculation out here, is also the internal rate of return, because it equates the market value or the present value of the issue to all the cash flows that is going to be received, right? Again, with this, there are 3 more important assumptions out here. We need to understand all these 3 important assumptions. First is that the issuer when the bond is issued and in the investor holds this security until maturity. Investor holds this security till maturity. Okay, because unless he holds the security to the maturity, obviously this promised yield is not going to be realized. Number two, the coupon that he receives every period. So this 70 coupon that he is receiving, he also invests this 70 coupon in the same or similar kind of instrument, which would give same or similar kind of return. Okay, and number three, at the end of the tenor, the issuer does not default. Okay, if these three conditions are met, then this IRR promised will be realized. Hence, this terminology, this IRR is also called yield till maturity, which means if you hold on to this instrument from the issuance date till its maturity, in fact, practically speaking, you could actually hold the security anywhere interim also. So in the secondary market, you could have actually purchased this security in, let's say, third year or fourth year if the issue is publicly tradable. Okay, but then the YTM would have differed depending upon what the market price you would have paid to acquire the security. We are assuming here that you have bought the security the day it was issued. So if all these three conditions are met, this is what you're going to realize, and hence this is called the yield to maturity. Contrary to that, let's say in the fourth year, in the fourth year, the market interest rate has changed, right? So we believed here that the market interest rate is going to remain same, and hence he's going to realize 10.29% at the end of. Now, whatever be the market interest rate that time becomes something called as the current yield. So how do we define that current yield? So let's understand. Let's say we are at the end of the fourth year. So if the end of the fourth year, what the price of this issue should be, because please understand, we are now on a trajectory, and that trajectory would mean that any issue which ultimately has been issued either at par or at premium must actually culminate to the face value if there is no default, right? Regardless of it being issued in discount or it is being issued in premium. Okay, if it is being held on to maturity, what you are going to get, and if the issuer does not default, is already known beforehand, right? So in this particular case, couple of things that we need to understand. One is that he is realizing a return of 7% here in terms of coupon, while the market interest rate is 10.3%. Hence, the issue is priced below the face value. Any issue which is priced below the face value at issuance is called a discount security, with the understanding that it will ultimately attain the face value. Contrary to this, if the coupon would have been, let's say, 12%, what do you believe the price of this bond would be? Naturally, the price of this bond would be more than the face value. Why? Because it is paying more than the market interest rate. Hence, it must be valued more than the face value itself. But ultimately, here also, it would finally culminate to the face value itself. Now, let's imagine that this is between t is equal to 0 to t is equal to 10. Let's imagine we are talking about t is equal to 4, right? So at t is equal to 4, what should be, if you are holding on to this bond, what should be what should be the theoretical fair value of this bond? So it is very easy to understand. You should and must do the same calculation, since you already know the YTM. All that you need to do is to keep all of those details as it is, but for the present value, because the present value is something that you need to find. So we say remaining tenor n is now equal to 6, right? The market interest rate, which is denoted in your calculator as I by Y as 10.29. The payment that you receive in form of coupon remains unchanged at 70. Face value, of course, is 1000. So we need to understand and find out what is the present value. Okay. So we input the details as has been required. So make the necessary adjustment in your calculation. Clear your work, second clear your work, and then put the details as 1000 is equal to face value, 70 is equal to payment, 10.29 is your market rate of interest, and 6 is the remaining tenor. You need to find out CPT PV, which is your. So once you do this, you press your CPT PV, the calci will give you an answer of something called as 857.92. Let's say we round it out to 858. Okay, so this is the theoretical fair value of this particular instrument if you would have held the instrument since its issuance till its maturity, or even if you are a secondary investor in the secondary market and you wish to purchase this bond. So the theoretical fair value of this bond should be 858. Watch that how this 800 value gradually is increasing and moving towards 1000. So from 800 it becomes 858 at the end of 4 years, right? Now, for instance, if it is 858, suppose the market price, this is the theoretical fair value. Suppose the actual market price of this issue, because the actual market price of the issue is also a function of supply and demand. So let's assume that the market price is also 858. So what is the current yield? The current yield would be then 70, which you are receiving as part of your coupon, divided by 858, which will invariably become 10.29, or the yield to maturity, which means that the price of the security has not deviated, the actual price of the security has not deviated from the trajectory itself, right? But suppose, for instance, the issue is priced at some amount 874, right? So then what is the yield? So if it is 874, all that you need to do, put 70 in the numerator and divide this by 874, which will give you again close to, sorry, this is, so this is the 8% thing. Which will again give you close to around, let's say, 8% on, right? Now let's say instead the market price is, let's say, 950. Market price of the security becomes 9. What is the yield then? Evidently you must know that the yield has now come down, right? There you go. So this becomes 7.36%, right? So this 7.36% is your current yield. So current yield is nothing but the coupon that you're receiving divided by the current market price, which may or may not be equal to the theoretical fair price. Now, what is the yield of this 7.36? Is this equal to the 10.29%, less than that? Of course, it is less than that. But what does this signify? So please understand, if the security would have been trading at or near the fair value of it, it would have still yielded 8% as far as the coupons are concerned, okay, which is also your coupon rate, which is fine. But till 4 years, we talk about 4 years, right? So till 4 years, you would have also collected this 70 premium of the last 3 years, right? Last 4 years rather, right? And you would have, what was our assumption? Our assumption that you also invest that in the same rate. So that means that if you would have invested this 70 coupon for 4 years. So the first coupon you would have invested for 3 years. Second coupon you would have invested for 2 years. Third coupon you would have invested for 1 year. At what rate? At the same rate of 10.29. So if you do this math and then add to the current coupon that you would have gotten here, and then divided the whole thing, it would, if the price is at 858, then your yield out here would have been close to or almost equal to 10.2. So anyway, all right, all that we need to know is that when we are talking about current yield with or without the reinvestment yield, we are essentially talking about the coupon in absolute value divided by the absolute price of the security. Okay, so we discussed yield to maturity. It is a very, very important concept. We discussed the current yield as well. Okay. So obligation of the issuer, of course, as we discussed, the regular payment of coupon on time, retention principle of tenor. Sources of cash flow, as we have mentioned, that sovereign or non-sovereign, there are two types of issuers. So one is the government or the semi-government kind of an issuer, and the second is a corporate issuer. So this government, if it is central government, it is backed by the full faith of it. They're default free, and the source of servicing the cash flow is obviously the tax collection. And non-sovereign is contingent on local taxing authorities, special taxes, etc. But as mind you, as I said, that the municipality which issues the local coupons, they do not have, or they cannot reap the benefit of the central monetary and the fiscal and the financial and the other economic policies. Okay, but the local government securities also almost enjoy the default free status. Okay, and since they enjoy the default free status, there is no need for any external or internal credit enhancement, which of course is required a default free in case of a corporate issuer in order to find a buyer for their issue, right? Obviously, for a corporate issuer, the rating of AAA is the highest ever attainable. It cannot exceed that. And any rating is obviously a direct function of the additional spread over and above the default free. Each issue of a corporate is unique. Issue may be project specific or general requirement. Credit enhancements is almost always required. What is credit enhancements or what is spread? We're going to talk about a little bit more on that in the subsequent slides. So let's just touch base upon what is meant by spread. So spread is essentially the yield difference. The yield difference between what? The yield difference between the corporate issuer and that of the treasury or the GSEC issuer. Okay. Or more precisely, the corporate issuer minus the benchmark. Okay. The benchmark could be that of the treasury security, a government security, or a swap spread. Okay. Now, what does this mean? This is the yield difference. So what does the spread mean? So please understand, as we say, that the risk-free interest rate is something obviously the safest instrument that one can trade into, right? But as we move along the corporate issues, we discussed that there will be an element of risk. An element of risk emanates from the default risk. The main risk is that of the default risk. We talk about that, which is known also as the credit risk. Okay. Second is there is something called as the delinquency as well. Delinquency is nothing but directly related to the liquidity problem of the issuer, when the issuer actually delays on the regular payment. Okay? It's not direct default, but a persistent delinquency would ultimately lead to default. Okay, now because of this additional riskiness, as I said that we would be only interested in investing into a corporate issue or a non-safe issue if we are compensated suitably for the risk that we are taking. Okay, so this additional risk is being measured by what is called as the spread. Spread is nothing but the yield difference between that of the corporate issuer and that of the GSEC or the benchmark. So suppose the benchmark interest rate is 2%, okay, and the corporate is giving you a coupon of 4%. So this additional 2% is the compensation for the risk that you're taking, which is also the measure of the spread. Okay, spread carries those risks and compensates you for it. Credit enhancement. Now, this is something of importance. Let me see how we have. Yeah, so we have covered it in details in the subsequent slide. We will talk about it. So here, let's understand a little bit more about the asset backing of collateral. What is exactly? Bonds are also called debentures. Debentures could be secured or unsecured. So we talked about collateral in our first few slides, if you remember. So your bond is as, the issuer's credibility is as strong as the collateral that is backing the issuer as well as the issue in general. Okay, so there are a couple of things that we need to know, that there are certain securities, there are certain assets on the issuer's balance sheet which provides the necessary cushion to the bonds in general that are floated in the market, right? Now, let's boil down a little bit on the capital structure first. So this is the waterfall structure. This is the famous waterfall structure that all of you need to understand as you move along, whether it's level 1, 2, or 3 along the ETAS fixed income portion of your CFA. You need to understand the structure of it. So as we know that in a balance sheet, in a traditional balance sheet, or any balance sheet for that matter, so you would have the assets on one side and you would have the liability on the other side. I don't care which side falls on which side. Asset could be on this side, liability on this side, doesn't matter. Or it could be vertically placed, doesn't matter. Okay. So all we need to understand is that the debt portion comes here, right? And the issuer's credibility is as strong as these two are. Okay. As strong as these two are, will talk about the issuer's credibility and issuer's strength. And if these are strong, these liabilities becomes easier to serve. And the liabilities become easier to serve would mean that the issues of such issuers will be obviously rewarded with higher rating and greater credibility. Now, within this debt structure itself, there could be different classes of debt existing on the same balance sheet, starting with the secured senior notes, secured unsecured, senior unsecured, and then thereafter the junior subordinate. So what is a secured issue? So secured issue, obviously, the senior ones, they enjoy the highest protection. What is meant by protection is that they would be rated high. They would have first claim on the company's operating cash flow, and they're protected by the general lien, general assets of the company. Some of the bonds are also covered bond. Covered bond would mean that they have a double layer protection, which means that they might be interested or they might be backed up with specific asset classes or specific projects. So they enjoy protection owing to that particular asset or this particular project, in addition to the overall general assets or general assets and equity backing the issuer. Okay. In addition to that, the senior unsecureds are the one which per se do not have any specific asset class as backup, but they have a claim on the issuer's assets in general. So they have a protection of the general lien, but they would not be enjoying the protection of a particular project or a particular asset class. Okay. But natural that because of this additional risk that they are taking, they would be demanding certain sort of compensation. This compensation comes in form of higher yield. Higher yield could translate either in higher yield, could translate into either higher coupon or lower price, or a combination of both, right? Similarly, the ones which are secured would be having lower yield. Lower yield would translate into either lower coupon or higher price of the issue. Now, please understand, the debt structure per se is highly columnar in nature as it is being visible. So the ones which are sitting in the senior most will be having or enjoying the most protection, followed by the mezzanine one, followed by the junior. And beneath all of them sits the cushion of the equity. So as strong the cushion of equity is, so safe are the debt columnar structure in general. Okay, now some of the assets, let's just discuss. Assets in general could be of two classes. One is the financial assets backing the debentures, called the collateral trust bonds. It could be the financial assets, it could be stocks, it could be other bonds, or it could be even working capitals in the forms of cash flow receivables. Okay. Secondly, there could be something called as equipment trust certificate. Now, the equipment trust certificate are entitled, or they are actually attributed to specific projects only. For example, if it's a railroad, okay. For example, if there is a special purpose vehicle or a special purpose project being envisaged, or let's say we talk about, let's say, a mining venture of the company, right? So these kind of projects can be, these kind of specialized projects can be delinked via some legal means from the corporates or the parent's balance sheet, and could be backing that particular project. That particular project could be backing the senior notes that are completely and singularly have this kind of backup. So the assets backing those specific projects, if they are in hard form, they call the equipment trust certificates. If they are in financial forms, they call the collateral trust bond. Okay. Now, coming to the amortization schedule, we talked about this, that the amortization schedule is basically nothing but the retirement of the bond in case it's a bullet bond, which means that entire principal is redeemed at principal, so there is no amortization. Okay. In case there is some portion of it is retired every year, so that's partially amortized. And then there could be that's fully amortized. If it is fully amortized, that would mean that equal amount of principal will be retired every year. So let's say, for example, the total issue is somewhere close to 1 million, okay? And the tenor is, let's say, 10 years. That would mean $100,000 would be retired every year until 10 years. That's called full amortization. A partial amortization would be the same structure, but first year it could be, let's say, 80K. Second year it could be 90K. Third year it could be 90K again. And like this, the last year there is a balloon payment of, let's say, 150K. Okay, so this is called a partial amortization. A partial amortization structure comes with a balloon pay as well. Balloon pay is nothing but a lump sum retirement of the principal at the redemption or the termination of bond itself. Now, is amortization a good thing? Yes, amortization is a good thing, as we have discussed, because amortization reduces the interest burden on the issuer, right? And also at the same time, it also decreases the probability that the issuer may default at redemption, because the issuer has to pay something in lump sum. At the same time, the issuer relieves itself from certain liquidity risk as well, because he does not have to partake with the entire face value at redemption. Okay, so considering all of this, of course, it's a safe bet. But from the investor's perspective, is this equally good? Well, it's good in some sense, because the safety net is there, but there is an opportunity cost to this. It does not come free of cost. And the opportunity cost is that the more the principal is retired, the lesser the absolute interest the investors would actually receive at every payment period. Plus, in addition to that, they would now be faced with finding the same kind of reinvestment, if not better kind of reinvestment opportunity. Now, not every time they would be receiving, or they would have the opportunity to invest at the same yield as they would have been enjoying thus far. Okay, so that's the amortization thing. Sources of of course, there is something called as the project cash flow, which is nothing but wherever the funds are being deployed. So the operating cash flow that goes on to service the coupon as well as the retirement or amortization of thing. In addition, under the supervision of the trustee, the issuer is supposed to maintain certain cash reserve accounts, whether part of the internal enhancement of credit or external enhancement of credit, as well as something called as a sinking fund provision. The only difference between these two are that in case of an internal or external enhancement of credit, the cash reserve account mostly is required to service the upcoming or the imminent coupon, whereas the sinking fund provision is basically an accounting measure that the issuer has to carry in its balance sheet in order to ensure that some portion of the principal, whether amortized or whether being paid in balloon or whether being paid in the amortized plus balloon manner or a bullet manner, but nonetheless, in that account, some portion of the principal will have to be kept mandatorily every year. So that's the sinking fund provision. So these are basically being done under the astute supervision of the trustee itself. We talked about the floating rate note. We talked about how floating rate notes are linked with certain benchmarks, certain indexes. And now the last thing that we need to understand is that how is always the payment happens in cash? No, it's not that. Payment can happen either through cash, which come in the form of coupon. Payments can be deferred as well, wherein we discussed that there could be some projects wherein the issuer may have just issued the bond, but the cash flow may be very tight, and for the first few years, the issuer may not be in a position to redeem those coupons. So in such a case, the coupons may be deferred. Of course, deferred coupons will carry higher rate of interest. Thirdly, there could be a barter transaction as well. The barter transaction would mean that in place of coupons or the principal, the issuer may revolve the debt itself if it is in good state, and the issuer may offer new bond or additional bond, new bond or additional bond, additional issue, to the existing investor. That can also happen. Or the issuer may, through the convertibility option, through convertible bonds, may actually offer the common equity as well. So these are different kinds of redemption, whether it is coupon or principal itself. Coming to the credit enhancement part of it, as we discussed that there are a couple of ways to enhance credit, internal and external. So internal is basically subordination, the waterfall structure that we just discussed. For your understanding, I'll redraw the waterfall structure. So this is a typical classic waterfall structure wherein the senior issue is secured the most, followed by the mezzanine issue, followed by the junior most issue. So this is a natural waterfall structure, which is also called the tranche security. All that it means is that the senior securities will have to be met for their interest, will have to be protected for their capital before the second in line or the mezzanine securities could enjoy the protection, followed by the third in line or the junior most. Of course, the equity structure is the last cushion. Until and unless the debts are required or the debts are serviced, the equity portion receives nothing, or should not at least receive nothing. Over collateralization. So as we talked about the assets backing the particular issue, so it could be so that the company's receivable cash flows or the particular assets or the total assets all put together maybe, let's say, $1,200 million, and they are only issuing debt. They're only issuing debt to the tune of 800 million. So this extra 400 million is earmarked as the over collateralization. Of course, over collateralization needs to be in hard asset or in cash. Reserve funds, of course, cash reserves or excess reserves, all that it means is that we need to have those cash collateral. Cash collateral is nothing wherein a portion of the proceeds, if the project for which the issue was raised, let's say it yields 12%. So the issuer remits 9% as part of coupon, and it has another 1.5% to manage its operational expenses. So that leaves with the additional 1.5%. So this additional 1.5% can be deposited in a cash account, okay, or investment in the high quality government securities as well, which can be liquidated at a moment's notice. So this is cash reserve account. This is called an excess reserve account. A cash collateral could be, on the other hand, wherein the issuer mandatorily deploys, regardless of whatever the project actually generates in terms of revenue, in terms of cash, regardless of that, issuer deposits mandatorily some portion of cash every year, every quarter in chosen high quality government securities in order to meet the demands, or in order to protect, in order to provide those necessary cushion. External could be, of course, credit enhancement, of course, could be bank guarantee being provided by a third party, line of credit being enjoyed, letter of credit, surety bond, CDS and CLN. So what are those? We will discuss a little bit. Of course, CDS and CLN are a little complex. I will explain that in my next chapter as we move along, when we will discuss in detail about CDS. Just know this, that a bank guarantee, a letter of credit, surety bond, CDS and CLN, except for this line of credit, except for this, all three of them also carry a third party risk. Okay, so what do we mean by third party risk? In most simple terms, all that it means is that, let's say your friend is there who has borrowed money from you. Okay, who has borrowed money from you. So you know this person, hence you say, okay, fine, I'm ready to lend you whatever the money is. But let's imagine that your friend also has another friend, and this friend comes up to you and says that, look, C requires money, so I stand guarantee to it. You may please lend money to C, right? Now, in case C defaults, A will have no recourse but to go, other than what has been stipulated, A will have no recourse but to go to B to ask for money. But understand this, there is a possibility that B might also default, or B may not want, or B not be in a position to honor the contract. So this is called the third party risk. Whether it's bank guarantee, whether it's letter of credit, or whether it's surety bonds or CDS, all of them have this third party risk embedded in them. Bank guarantee is a simple instrument wherein the commercial bank of the issuer, which carries the operational, on the current account, with whichever bank has the current account, that provides the guarantee, or any other bank can also provide the guarantee with which the issuer might have entered into an agreement. A letter of credit is diminishing guarantee, especially post 2008. Surety bonds are again being issued by a third party, in the sense, for example, there is a conglomerate and there is a subsidiary. That the subsidiary raises the debt. So in this case, the surety bond may be provided by the conglomerate, that in case the subsidiary defaults, the conglomerate, which is the parent company of the sub, will meet the demand. The CDSs and CLN are basically insurance contract wherein there are monoline insurers. The monoline insurers provide the necessary guarantee against a default risk against a certain premium. Okay, so these are the different means of credit enhancement. All you need to know that primarily there are a couple of ways. One is internal, second is an external. Whichever, regardless of whichever enhancement is being provided, we must value the most liquid, the most accessible enhancement as the most valuable. Okay, so over collateralization, very good. Reserve fund, very good. Subordination, well, good enough. Okay, if you're a senior note holder. But if you're a mezzanine note holder, or even if you're a senior note holder, but the mezzanine note holders or the junior note holders are very thin compared to what you are, then they will not be able to provide you the necessary cushion, right? So long these kind of guarantees are distant or remote from the original issuer, you would face an additional risk in the form of third party. Contingency provision, other important ones, of course, we talked about this, call option. We talked about what is a call option. Call option accrues, or a call option is to the issuer, to the benefit of the issuer, and can be exercised at the discretion of the issuer, should the issuer so believe or observe that the market price of the bond has exceeded certain limit. So in this case, the issuer does have the right to call on the bond. But at the same time, any callable bond must also specify the call protection period, which means that the issue has been issued for, let's say, 10 years, but the issue cannot be called for the first 2 years, regardless of where the market goes. Okay, so this is the call protection period. But after 2 years, well, if the market price exceeds the bond becomes too valuable, but obvious that issuer would like to call that bond back and exercise that option. And then while it exercises that option, there are 2-3 different dates on which it can actually call on that date. The first called The first date the issuer calls is called the yield to first call. Similarly, and that's the best call that you can think of. Second, now the expectation is that 70 or 80% of the bondholder would redeem their security. So that's the yield to first call. Second comes yield to second call, right? And third is yield to worst. Why it is called yield to worst is because the issuer, when it is going to issue the first call, that is where he is going to issue the highest premium. Okay, so suppose what would happen is that the market is already priced at, let's say, 103% of the face value. Okay, the issuer might say that fine, let me just give you 103.5% or 104%. Okay, and you pay me back. The idea is that in such a situation, most of the holders would redeem the bond back, right? So the ones who would not be, for them, after a specified date, the issuer might say, all right, I have recouped more than 70% of my original issue. Now I'm going to call. But in this case, he will not offer 104%, but he might say that, well, I'm going to now offer only 103%. If you're interested, you can sell me the bond back. He would obviously exercise the option. The only thing is that when the bonds are getting redeemed, it's basically a little complex in nature. It would be governed by the principles of the indenture itself. And last is the yield to worst. Obviously, it will not exceed the par value at all. The issuer might say, now it's only a year or two remaining for the redemption, and I'm not going to offer you 103% of the issue, but I'm just going to offer about 100% of the par value. If you're interested, you may redeem the bond. Understand why it happens, because when the issue is finally approaching its maturity, it's only a year or two left. Anyway, if the issuer has not defaulted, that means that he's anyway, regardless of whatever be the market price, he's only going to get 100, right? So that's what the issuer does out here. So these are basically call schedule that's being there. Now the call schedule will also come with the different types of call option. So what are those different types of call? American call option, European, and Bermudan. So what it means, European would mean that you can call the issue only on specific dates until its tenure. So which means that after the call protection period is over, let's say it can only call on June 30th of each year. June 30th and December 31st of each year. Okay, this may coincide with the coupon date as well. So that's called the European type of call option. American type of call option would mean that after the call protection period, any date is a good date for the issuer to call, should he believe that his issue is very well priced, very highly priced over the market value. The Bermudan type are a mix of these two. So that means that they can call, but they can only call a certain portion on a certain date. Obviously, the frequency will be more than the European type. The put option, as we have also discussed, that if the opposite part of the call option is the put option accrues to the bondholder, and the bondholder may exercise the puttable bond when he believes that the market price of the bond is falling drastically than what was expected. And why the market price would fall? Because A, the yield has gone up, or B, the credit worthiness of the issuer might have gone down. In both these cases, the market may not want to price the bond as it would want to. So in such case, the put option may want to exercise the option. Keep in mind that this is a rarity, which means that means that this is not very conventional, that put option are there in the bond. The embedded option mostly are call option in nature. There could be bonds also which may carry all the three features of it may be convertible, at the same time it may be callable, or at the same time it may be puttable. Of course, these are complex, highly complex structure. We will get to it when it is required. Let's not talk about something called as the covenants. What is meant by covenants? So in plain terms, covenants are nothing but basically the conditions, right? So what we mean by the conditions, these are scripted in the bond indenture or the trust deed itself. Okay, and it's a series of what the issuer can do, which are basically called the affirmative covenants, and second is what the issuer must not or should not do, which are called the negative covenants. Please understand, compliance with law, tax payment, they are not part of covenants. Okay, what you have to do, what you have to legally follow, they are not part of your covenants. Okay, so the affirmative covenants, the example could be, one of the solid example could be DSCR, debt service coverage ratio. So it may specify that the debt service coverage ratio at least has to be equal to 1 or more than that. Or the, let's say, interest coverage ratio. The interest coverage ratio at least has to be, let's say, above 1.5. So these are kind of affirmative covenants, basically the conditions or the stipulations that the issuer has to follow. On the other hand, the negative covenants could be that something that the issuer must not do. For example, the issuer should not gamble with the money of the bondholders. So which means that it should not actually enter into any risky project, other than what has been already specified, or issue additional debt, which could be to the detriment of the existing bondholder, right? Or it should not lavish itself by showering huge amount of perks to its key employee, or it should not pay out of the way dividends to the existing equity shareholder, right? Because all of these put together may actually jeopardize the prospect of the bondholders. So at the cost of that, these things should not be carried out. So negative covenants understand that bondholders typically do not tell or cannot tell also the issuer how to run their business, because for one simple reason, that the bondholders really do not share in the upside potential of the company unless it's obviously a convertible one. Now that said, it's also equally true that they cannot put themselves into disadvantage, and they need somebody to monitor the issuer's activity on a day in and day out basis. Okay, so that's the key of it. Covenants, if they are too restrictive, obviously will again hamper the progress or hamper the future prospects of the company as well. So they're very carefully drafted in order to maintain a balance. Obviously, that's the job of the trustee. Some of the issuers may want to give additional warrant to the bondholder, that works as a perk, or that actually does not work as a perk. That could be actually part of the coupon itself. All right, so that brings us to the end of this session. I hope you enjoyed. I am Abhishek Bal, and this happens to be my WhatsApp or callable number. I'm from India, and I've been teaching for more than 5, and now it's not 7, close to 6 years plus. Okay, and you could also direct your question to this email ID of mine, and I'll be happy to oblige. And this happens to be the best slide. In case anybody did not know, his name is Muttley, and he's one of my favorite characters. My golden retriever also looks something like that, but he's not a mongrel. He's a purebred. All right. Thank you then. And I see you